Looking at the monthly chart, the macro trend displays a powerful, long-term bullish structure. For the vast majority of the preceding months, our green 8-month moving average has sustained a clean position above the red 21-month moving average, confirming that macro momentum remains firmly in favor of the bulls. This structural uptrend is heavily validated by dominant buying pressure across both price and volume. On the main chart, green bullish candles heavily outnumber and dwarf the red bearish candles. Looking down at the volume bars at the bottom, we see the exact same pattern. Green buying volume consistently outperforms red selling volume, proving systematic institutional accumulation on a massive scale. The price profile on the left highlights a massive accumulation base. Price spent approximately 4 to 5 years consolidating within a tight horizontal range between 19 and 50. This prolonged consolidation built up prominent high-volume peaks on the profile, representing a monumental launchpad of energy where supply was thoroughly absorbed. The definitive structural breakout finally occurred when the price surged above this multi-year range with a long, high-momentum green candle. To execute this setup safely, our entry point is established at approximately 50. This entry timing deliberately aligns with the opening of the second candle right after the breakout, confirming the validity of the move. For risk management, our stop loss is placed at around 43. Following our rule to use either the midpoint or the low of the first breakout candle, whichever is lower, we anchor our stop to the absolute low at 43. This provides the macro trade with proper structural breathing room while keeping our downside incredibly tight.
We ride this explosive upward extension and plan our final macro profit-taking exit at approximately 1816. This target triggers right after the next extended long green candle prints, allowing us to exit directly at a stalling pin bar candle, which typically signals that the immediate buying momentum is exhausted. Let's break down the exact mathematics of this trade. By entering at 50 and exiting at 1816, our total captured reward is a massive 1766 points. Meanwhile, with our stop loss firmly anchored at 43, our total risk exposure is strictly limited to just 7 points. When you map this out, it leaves us with an exceptional 1 to 252 risk-to-reward ratio. This level of extreme mathematical asymmetry is exactly what we look for in long-term breakout setups, ensuring our upside vastly outweighs our downside.